Good morning. Good morning, all of you.
Good morning, sir.
Okay, thank you. And today we are going to start a new chapter that is called Inventories, according to Sri Lanka Accounting Standard number 2. This is series 2, right? Sri Lanka Accounting Standard 2, Inventories, and today's session is about measurement. So how to measure the cost of inventories. So you have studied so many times about this concept inventories. So under the inventories, you have learned about what is inventory valuation method, measurement method. It includes what a FIFO method, LIFO method, weighted average method. So that kind of stuff you have studied in a different subject, like management accounting or cost accounting. May study there, but now we are going to discuss these inventories based on LKAS 2. The same stuffs we are going to discuss here, but in a formal way as per the guidelines given by LKAS 2 inventories. So it's a very familiar concepts for you. A learning outcome of this session, of this presentation. At the end of this section, the students will be able to understand, describe the concept of inventory and measurement of inventories, how to measure the cost of inventories, accounting for inventories, what are the double entries of inventories, and cost and net realizable value of inventories. Cost mean the purchase price, and net realizable value, sales price minus any associated cost to make that sales. So that is net realizable value. So those two concepts are very important in accounting for inventories. And the disclosure in relation to inventories, or what are the things have to disclose in their statement of financial statements. So these are the learning objectives of this section. And we first move to the LKAS 2. So LKAS 2, the objective of this standard, LKAS 2 is about inventories. The objective of this standard is to prescribe, right? It's to prescribe. It gives a concrete definitions and concrete procedures regarding inventories with respect to accounting. So the objective of this account standard is to prescribe the accounting treatment for inventories, how to handle the issues arises related to inventories. The primary issue in accounting for inventory is the amount of cost to be recognized. So amount of cost to be recognized as an asset and carried forward until the related revenue are recognized. So you can find the value of inventories in a balance sheet as a closing. So inventory under the current assets, and you can find the cost of, when you calculate cost of sales in income statement, you can find there closing inventory. So to disclose that amount in balance sheet or income statement, uh, the presenter of financial statement should clearly understand how to measure the cost, how to measure the carrying amount. So closing inventory of end of this period, say 31st March 2021, may be carried forward to the next year, that is first of April 2021. So it will be carried forward. The primary issue in accounting for inventories is the amount of cost to be recognized as an asset in the income statement, so in the balance sheet, and carried forward until related revenues are recognized. So to calculate the gross profit and to calculate the cost of sales, the measurement of the closing inventory is very important. The standard provides guidance on determination of cost and its subsequent recognition as expenses, including any written down to net realizable value. Right. So you may encounter some calculation about this written down value on inventories. When it will happen, we compare the cost of inventory, carrying amount of the cost of carrying amount of inventory, and the net realizable value. In such a cases that where the carrying amount, that's the cost of the inventory, is substantially less than the net realizable value, so that time we have to choose the lower value. So that time the accountant should present that inventory at a lower cost, that is net realizable value. In some other circumstances, like in case of fire in the warehouse store, and there are some obsolescence, and there are some theft, and there are some kind of natural um, so inherent wastages of inventory. So that sort of times, how to handle that kind of events. It also provides guidance on the cost formulas that are used to assign cost of inventories. So due to the market condition, technological changes, technological improvement, the value of cost may be go down. So that time, what's the treatment? In case of fire accident, what's the treatment? That's the scope of LKAS 2. So this standard applies to all inventories. It applies to all inventories except work in progress arising under construction contract, including directly related service contract. See LKAS 11, construction contract. So in the recent updates in LKAS 2, so under the construction of contract also, the inventories in the inventories come under the uh, construction of contract, some part of which you can include this LKAS 2 also. So we will discuss in detail in forthcoming slides of the session. And second, a financial instrument, the stocks. Stock mean what? Investment. When you invest the company's or organization's money on another company's shares, equity shares, preference shares, bond, or you may invest in fixed deposits in bank, commercial banks, or other specialized finance institutions. So that is called financial instruments, derivatives, options. Financial instruments, see LKAS 32, finance instrument, uh, presentation, right? LKAS 39, finance instrument, recognition and measurement. So LKAS 32 is about finance instrument, especially presentation. LKAS 39 also is about finance instrument, but it deals with recognition and measurement. So that kind of investment, financial investment, is kind of stock, but it cannot come under LKAS 2. Biological assets, cattle farm, so like Ambewala. So their stock is cows, feeding cows, kettles, and birds, some pets, right? So that kind of biological assets are not come under LKAS 2, and some agricultural undertakings. So paddy, for example, also not covered under here. So biological assets related to agricultural and activity and agricultural produce at this point of harvest. So for the relevant accounting standard for the agricultural undertaking outputs, LKAS 41, that is agriculture. Important reasons for too much emphasis on inventory valuations. So why do we care about? So in the A level accounting, you have studied inventories. In the first year, you have studied here. The second year also you have studied in the management accounting or cost accounting. Again, you are studying in the third year about the costing, inventories. So why do authorities give more attention on inventories? Why? So what's the why the important reason for too much emphasis on inventory valuation? Right. First, the proper determination of profit. When you see the income statement to calculate cost of sales, so opening balance, opening inventory plus purchase minus closing inventory, then you will get cost of sales. This cost of sales is deducted from sales. Sales minus cost of sales equal gross profit. So here, for the determination of the profit, gross profit, it gives more importance on inventories, opening inventory and closing inventory. So to identify the proper value of gross profit, it is necessary, it's very important to assess the inventory in proper way. So proper determination of profit. Inventory is directly connected with profit. Higher the inventory, higher the profit, and vice versa. You might study it in accounting that there is a positive relationship between value of closing inventory and sales and profit. So when you overvalue the closing stocks, closing inventory, your profit may be overstated. If your inventory is undervalued, then profit may be understated. The true financial position, when you take about the balance sheet, cosine stock is an assigned asset in the balance sheet. When you look at the current assets, you may find inventories. Most of the 99% of companies has what the inventories. To ensure sufficient inventory for the production sales process, you might start at EOQ, and maximum stock level, minimum stock level, average stock level, buffer level. So why do you study this kind of stuffs? Because to ensure uninterrupted production process, to ensure sufficient inventory for the production sales process. So you need inventories. Inventory is accounted at its physically verified value, thereby creating likelihood for mistakes. So inventories, end of each period, each financial period, most of the organizations go for inventory count, inventory valuations. Most of the time, the inventory valuation is based on the physical counting, rather than book value, rather than just go through the books or documents. It it should physically counted and valued. So because of there are so many mistakes. Inventory defined. What do you mean by inventory? Inventories are the assets. Inventories are the assets held for sale in the ordinary course of businesses, finished goods. Held for sale. Inventories are the assets that are held for sale in the ordinary course of businesses. Finished goods. And also include in the process of production of such sales, raw material and work in progress, right? Raw material. You purchase raw material for the purpose of production. So that is raw material should be considered as a inventory, and finished good as an inventory that's ready for sale. And some items are in between raw material and finished goods. In between raw material and finished goods, work in progress. The production process has started already, but yet not yet finished during the end of accounting period. So that also can be included in the valuation of inventory. In the form of material or supplies to be consumed in the production process or in the rendering of services. There are some service institutions, when they are providing services, they should keep some sort of inventories in hand. So glue, oil, some kind of chemicals. So think about the car service stations where they use so many chemicals and so many items like grease, oil, and kind of washing shampoo, right? So these are things may be consumed when they're providing services, right? In the form of material or supplies to be consumed in the production process in the rendering of service, stores, spares, raw material, and consumables. So give me 1 minute. Right. So in the form of material or supplies to be consumed in the production process or in the rendering of services. So stores, spares, raw material, and consumables, right? Measurement of inventories. How to measure? This is very important area. So there are so many calculations here. Inventories shall be measured at amount which is lower of cost and net realizable value. Inventories shall be measured at the amount whichever is lower of cost and net realizable value. Net realizable value is the estimated selling price in the ordinary course of business. Net realizable value is the estimated selling price in the ordinary course of business. Less you have to deduct the estimated cost of completion and the estimated cost necessary to make the sales, right? So you have a particular item of X, you can uh, you can sell the item for 20 rupees in the market, in the ongoing market. Anyhow, to sell at 20 rupees, we have to make some uh, expenditures. We have to make some upgradation like polishing, packaging, that kind of, right, stuff, that kind of expenses you may incur. Say, for example, the cost incurred will be 5. So in the market price is 20, and that market price is 20 can be achievable only after you have spent 5 rupees for just polishing and, right, and cleaning that item. So now the net realizable value is how much? 20 minus 5 equal 15 rupees. So this is the net realizable value. Net realizable value is the estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated cost necessary to make the sales. So measurement of inventory. So we have to take floor value precaution concept, lower of cost and net realizable value. We have to compare both cost of the inventory and net realizable value. So we have to choose lower value, lower value. If cost is higher than net realizable value, we have to take value of inventory is net realizable value. So compare these two, the cost is higher than this value. So therefore we have to take NRV. If NRV, if cost is less than NRV, the value of inventory is cost. Very simple logic. So this is the illustration. So as said, the closing date of financial year 2018, the company A has three uninterchangeable product portfolios. The historical cost and net realizable values of those items are given below. So there are three items X, Y, Z. So quantity 1000, 2000, 3000, and historical cost. This is the cost 15, 20, 10. So total cost of items per unit is 45, and net realizable value 40, 22, 9. Right. Determine the carrying amount of the inventory to be shown in the financial position statement of financial position as at 31st December 2018. Here we will work out on this. Many students have posted the answers, and so when we take the value of the items, we have to take one by one, right? So take X item X. So we compare still cost and NRV. So which is lower? NRV is lower. So we have to take this 14. Right? We have to choose this 14. We have to take this value. Right? We take this value. And in case of Y, we compare cost and NRV, and we take this value. And Z, so 10 and 9. So we choose 9. Right? So X into X for X. So 1000 into 14 rupees equal 10 into 14, 14,000 plus 2000 into 20, that is 20,000. So 20 into 2000, 40,000, and 3000 into 9, 27,000. So altogether it's equal 14,000, 40,000 plus 27,000. So equal 81,000. So value of inventory should be disclosed in the financial statement is 81,000, right? Now cost of inventories again. So cost of inventory shall comprise of all cost of purchase, the purchase price, cost of purchase, cost of conversion. So input, you purchase raw material and you convert raw material into finished good by applying direct material, direct labor, overhead cost. So you include that conversion cost. You convert raw material into finished goods. So there are some costs may incur in that process. So you have to include that cost also. Other costs incurred in bringing the inventories to their present location. Bringing the inventories in the present location. So you may purchase in Colombo, but you have to install in Ampara. So the transportation cost, custom duties, stamp duties, uploading and installation, so carriage cost. So that kind of cost will be considered according to this criteria, C criteria. Other costs incurred bringing the inventories to their present location and condition. So it includes what? Cost of purchase, cost of conversion, and other cost equal to what? Cost of inventories. So in detail here, cost of inventories, it has three parts: cost of purchase, cost of conversion, and other cost. Cost of purchase, cost of conversion, and other costs. Cost of purchase includes the purchase price plus custom duty if imports from foreign country overseas is custom duty, other irrecoverable taxes, right? Irrecoverable, right? Some taxes can be recoverable, irrecoverable. For example, VAT can be recoverable, VAT input, VAT output. So cleaning charges, loading and unloading cost, transport cost, minus, right? You can deduct trade discount, not cash discount, right? Not cash discount, so trade discount and rebates. So right, so these should be include the cost of purchase. When you look at cost of conversion, so raw material to finished goods. So direct conversion cost equal direct labor cost, material cost, and royalties. Indirect production overhead also includes fixed production overhead and variable production overhead. Fixed production overhead includes plant depreciation, factory rent. So we're here to discuss some kind of adjustments here allocated to inventories based on normal production level, right? So when we allocate the production overhead, so there are some adjustments here to make, and so it's based on allocation to the inventories. So the fixed cost will be allocated to inventories based on their normal production level. So we will discuss in detail in forthcoming slides. So in the variable production overhead, so overhead example, indirect raw material, indirect wages, etc. So it's very closely related to output, number of units, variable overhead. So it is absorbed, allocated to the inventories based on their actual production level. Actual production level. And other cost includes specific pattern designing expenses, right? Before the start production process starts. Now we look at the cost of purchase, this part. Cost of purchase. The cost of purchase of inventories comprise the purchase price, that's mean equal to the cash price you have given to the seller, import duties and other taxes other than those subsequently recoverable, right? If you're able to recover that expenses, so that cannot by the entity from the taxing authorities. So transport, handling and other costs directly attributed. So it's very important, directly attributed. It should be directly attributed for the purchase of inventories, directly attributable to the acquisition of finished goods, material and services. And trade discounts, rebates and other similar items are deducted. Should be deducted in determining the cost of purchase. So these are the basic idea. So we have an example here, right? So using the following information of XY, so X determine the cost of purchase of 1,000 units of material acquired for the production purpose. So here the details are given, so you can work out on this.